How the Federal Reserve is now competing with banks for deposits. Enter the reverse repo facility. The U.S. Federal Reserve could be competing with commercial banks due to a facility called the Overnight Reverse Repurchase Agreement Facility, which has currently drawn in more than $2 trillion in deposits. According to analysts, this has affected bank deposits, as investors run to grab the higher yields it offers compared to traditional banks. The recent banking crisis has made people worried about the security of the U.S. banking system, and while at a high level, some are still determining the causes that led to the fall of Silvergate, Signature, and Silicon Valley Bank. There is another phenomenon that is affecting the health of this system. HE facility, which was introduced back in 2013 by the Federal Reserve as a backstop for a possible shortage of low-risk investment options in the market, finished last month with $2.3 trillion in funds, down from the record number of $2.5 trillion reached in December 30, 2022, per numbers of the St. Louis Fed.
It's where that quantity of capital and quantity of liquidity has been most beneficial that its withdrawal is going to continue to be felt. And that is in the most speculative parts of the market, the most richly valued parts of the market. So while I think we've seen a bounce back over the last, 5 or 7 trading days in some of those sectors, whether it's unprofitable tech, if you will, whether it's some strengthening in some of the smaller cap sectors or sectors, levered to, some of the more speculative parts of the market. That's, I think, where we're going to see this withdrawal of liquidity really start to bite.
So, Lisa, I guess I wonder how much of that is already in the market. And I'm just looking at the front end of the curve now, whether you're looking here or in Canada, for example. The Bank of Canada hikes 50 bips. They say we can do more if we need to. We kind of knew that was going to happen. But the market reacted quite strongly anyway. What's appropriately priced?
So, look, I think we need to remember, from our perspective, what's happening on the front end of the curve is all about, what people think is going to happen to rates. What happens on the back end of the curve is very much about what people think is going to happen to the balance sheet. And so I think, we saw, a pullback in the 10-year and the 30-year over the last, kind of 3 or 4 weeks. And our sense is we may give some of that rally in long duration treasuries back as people begin to further internalize what this withdrawal of liquidity looks like for that longer duration bid.
So that's the longer term story. And as you say, that might be driven by the balance sheet. Let me ask you what you expect to hear next from the Federal Reserve. I mean, we just went through some data on the U.S. economy. The data suggesting, according to our colleagues on the Markets Live blog, that the economy can handle a hawkish Fed. For how much longer do we hear a hawkish Fed, Lisa? Do you have any kind of pivot point in mind?
I think the Fed's going to remain extraordinarily hawkish through September. But I do think that September is going to be a watershed, and it's going to be a watershed in terms of the deceleration of Fed hawkishness, if that makes sense. I mean, let's think about it. We're going to, live through what's likely to be 50 basis points in June, 50 basis points in July, potentially 50 in August as we get closer and closer to, Fed funds futures forecast for the full year. And at the same time, that quantitative tightening is ramping up. And we don't get to steady state on those things until September. So I think by the time we get to September, we should have some more constructive inflation data. That will give the Fed some cover. We'll also be approaching the midterm election season when the Fed typically, in their spirit of independence, wants to try to quiet down and not get into the fray of campaign season. So we're targeting September for a shift in the tone from the Fed. But it's going to be a rocky summer from where we sit, and the Fed's going to keep their foot on the accelerator.
So, Lisa, this is such a simplistic question, but what do you buy and what do you sell on that? In that, if we're in for a higher volatility regime until things calm down, what do you do with that? We haven't been in that kind of regime in a very, very long time.
Yeah. So our advice to clients has been to be a very active asset allocator and be a very active security selector. We're advising, maximum levels of diversification by region, by sector, by exposure to style and quality factors, by capitalization, and we're really just hollowing out the parts of our portfolio exposure that's very sensitive to rates. And so that has left us, surprisingly, very focused on a suite of cyclical-oriented sectors like energy, like industrials, like financials, like some consumer services, and balancing that with some more defensive exposures, most particularly healthcare.
Okay, so that combination of the cyclical and the defensives. On the subject of that cyclical, you mentioned commodities, you mentioned oil. Is that still a good place to hide, Lisa? Do you think we've seen peak oil? I mean, clearly the geopolitics, very difficult to call here, but you have the geopolitics pushing the supply side, but then you have the demand side from China. Where do you think this heads?
I think we go higher before, we get to a resolution around equilibrium. Clearly, we've gone through this period where much of the pressure has, quite frankly, come from the constrained supply side and what's going on emanating from the Russia-Ukraine war. But what we have to appreciate, exactly to your point, is that China and, quite frankly, a swath of emerging markets have been, if not slowing, close to a recession. And so as those economies come back, which, again, we have a very high degree of confidence they will, towards the third and fourth quarter of this year, in large part because we do think that China is going to aggressively stimulate into the next Communist Congress in September, when Xi goes for a historic next term. And so, if we see a spike in demand, in the back half of the year, I don't think that the supply situation globally is going to be fixed by then. And so we're looking at least another 6 to 12 months, in our humble opinion, of tightness in oil markets here. And so that trade's got more ways to run.